You've probably taken trades that looked perfect. Clean breakout, strong momentum, everything lined up exactly how you expected. And then suddenly, price reversed, hit your stop loss, and kept going in the opposite direction without you. That's frustrating, right? But here's the uncomfortable truth most traders never realize. It didn't happen because you were unlucky. It happened because you were the liquidity. What if I told you the market isn't random, and it's not out to get you personally, but it is designed in a way that consistently traps uninformed traders? And once you understand how liquidity actually works, you stop reacting to price and start anticipating where it's going next. That's exactly what we're going to break down today, using the same concepts professional traders use to align with institutional money instead of getting run over by it.
Before you even think about entering a trade, you need to understand one critical thing: where price is operating. Because if you don't know where you are in the market structure, every trade you take is basically a guess. And that's where most traders go wrong. They open a chart, zoom into a small time frame, see a pattern, and jump in without any real context. But the market doesn't work on your entry time frame. It works on a hierarchy of time frames. So instead of asking, is this a buy or a sell? The better question is, where is price sitting within the bigger picture? This is where the concept of a trading range comes in. A trading range is simply the area between a high and a low where price is currently moving. But it's not just any random high and low you draw on your chart. A valid range forms only after the market makes a clear, aggressive move in one direction, followed by a retracement.
That initial aggressive move is what we call an impulse. It shows strong intent from the market. Then when price pulls back, it starts creating a structure between that high and low. That's your range. And inside that range, price is not moving randomly. It's moving with purpose. Here's where it gets interesting. Once you identify the range, you can start dividing it into two key areas: premium and discount. If price is in the lower part of the range, it's considered discount, which is where buying becomes more favorable. If price is in the upper part of the range, it's considered premium, where selling becomes more favorable. This alone already gives you an edge, because now you're not just chasing price, you're positioning yourself based on value. But the real power comes when you combine this with liquidity, because the market doesn't just move between highs and lows, it moves toward liquidity. And liquidity is simply where orders are sitting. Think of it like magnets pulling price in specific directions.
There are two main types of liquidity you need to understand: external liquidity and internal liquidity. External liquidity exists outside the trading range. It sits above major swing highs and below major swing lows. These are the obvious levels where retail traders place their stop losses or enter breakout trades. And because so many orders are clustered there, these areas become prime targets for institutions. Internal liquidity, on the other hand, exists inside the range. This includes things like minor highs and lows, equal highs or lows, and something very important called fair value gaps. Internal liquidity doesn't usually act as the final destination for price. It acts as fuel. It's what price uses along the way before reaching external liquidity. So now you start to see the real picture. Price doesn't just move up or down randomly. It moves from internal liquidity to external liquidity. Internal is the fuel, external is the target. And if you understand this, you stop taking trades in the middle of nowhere and you start aligning yourself with where the market is actually trying to go.
Let's say price is inside a range and starts moving upward. Along the way, it might dip slightly to grab internal liquidity, maybe filling a fair value gap or taking out a minor low. But that doesn't mean the market is bearish. It's just building momentum, collecting orders before pushing toward the external liquidity sitting above the range high. This brings us to a concept that separates
average traders from advanced ones. The liquidity chain. The market doesn't move in a straight line. It moves in a sequence, almost like stepping stones. Price constantly rotates between internal and external liquidity. It grabs internal liquidity, then moves toward external liquidity, then creates new internal liquidity, and repeats the process. And one of the best ways to read this behavior is through fair value gaps. A fair value gap forms when price moves so aggressive that it leaves an imbalance behind. These gaps often act as areas where price might return before continuing its move. But here's where it gets powerful. How price reacts to these gaps tells you what it's likely to do next.
If price comes back into a fair value gap and respects it, meaning it reacts and continues in the same direction, that's a sign of strength. It tells you the market is likely continuing toward the next external liquidity level. But if price breaks through the gap and fails to respect it, that's a sign of weakness. And in many cases, that gap can flip into what's called an inverse fair value gap, acting as resistance instead of support, or vice versa. This shift is crucial because it tells you the market may be changing direction, and instead of guessing, you're now reading the behavior of price based on how it interacts with liquidity. Now let's talk about one of the most important concepts, and probably the one that causes the most pain for traders: liquidity sweeps. This is where the market intentionally moves beyond a key level, triggers stop losses and breakout entries, and then reverses sharply. You've seen this happen. Price breaks above a resistance level, looks like a strong breakout, you enter a buy, and then it immediately drops. That's not bad luck. That's a liquidity sweep. The market needed those buy orders and stop losses to fill larger positions. Institutions can't just enter massive trades whenever they want. They need liquidity, so they push price into areas where they know orders are sitting. They trigger those orders, create the liquidity they need, and then move price in the real direction. But not all sweeps are equal. The highest probability sweeps happen at external liquidity levels, especially during high volume sessions like the London Open or New York Open. That's when the market has enough participation to create meaningful moves. Sweeps that happen inside the range, targeting internal liquidity, are generally less reliable. They can still work, but they're more likely to be noise or traps. So instead of chasing breakouts, you want to wait for the sweep. Let the market take liquidity first. Let it show its hand, and then look for confirmation before entering in the opposite direction. When you put all of this together, trading becomes much more structured. You start by identifying the higher time frame range. Then you mark out where the external liquidity is sitting. After that, you observe the internal liquidity and how price is interacting with it. You watch the liquidity chain, how price moves from one level to another. And finally, you wait for a sweep at a key level before looking for an entry. At that point, you're no longer guessing. You're not reacting emotionally to every move. You're reading the market with logic and intent. And this is the biggest shift you need to make. Stop asking where to enter. Start asking where liquidity is and where price is likely to go next. Because once you understand that, the market starts to make a lot more sense. You'll begin to notice patterns you never saw before. You'll stop getting trapped in obvious setups. And most importantly, you'll start aligning yourself with how the market actually works instead of fighting against it. The truth is, the market is engineered around liquidity. It's not random. It's not chaotic. It's structured in a way that rewards those who understand it and punishes those who don't. So if you've been struggling, if you've been taking losses that don't make sense, it's not because trading is impossible. It's because you haven't been looking at the right things. Now you are. And if you take the time to really understand these concepts and apply them consistently, you'll start to see a completely different side of the market. And trust me, once it clicks, there's no going back.